I was reading what like I don't want to get like yes. I don't want to give like America
Okay, folks, couple of things. One is, if you get a chance, get on Brightspace and make sure your grade scores match up to what you have on your quizzes. Just, might as well get those lined up. I also sent that grade checker sheet. Don't take it too literally. I mean, in a sense, you're going to enter your numbers. You're going to see what you can get. So, but I wanted to kind of, make it as transparent as possible in terms of you seeing what your total score will be. Final reminder, of course, your project is due a week and a half from today. So expect me to nag you consistently for the next 10 days, 11 days. No, because the end is near. So with all those in place, let's talk a little bit more about dividends. Now, we were talking about good reasons to pay dividends. And one of those reasons is that if you acquire investors who like dividends, a dividend clientele, then you should continue to pay dividends. You get locked in. And sometimes that can create a problem because you get locked in and then your business changes, you're not sure what to do. Today I want to talk about a second reason why companies might initiate dividends and increase dividends. This is from a very old study. It's almost 30 years old, but it's been updated since, and I'll talk a little bit about what's changed. And what this study looked at very simply is what happens to the stock price of a company when a company announces a dividend change. Remember, this is not on the ex-dividend date. This happens 3 weeks ahead. The board of directors gets together and says, we're going to increase dividends or we're going to cut dividends. It just looks at the stock price effect. So when companies announce a dividend change, the stock price jumps. But don't get too excited. It jumps about 1% on average. So dividend increases are, on average, good news. Dividend decreases, on average, are bad news. And I want somebody to explain a disconnect here. When dividends go up, the stock price goes up about 1%. When dividends go down, stock prices go down about 5%. So why is a dividend increase less good news than a dividend decrease is bad news? Anybody want to give that a shot? Why is a dividend cuts, in terms of news effect, greater? Yes. In fact, if you remember that graph of dividend changes, dividend increases outnumber dividend decreases 4-to-1 to 5-to-1. So when it happens, people say, things must be really bad for you to cut dividends. That was the original study, and for a long time, this was the story that was told. Dividends are good signals because, and you're saying, what am I signaling? Remember, when you increase dividends, you effectively have to have earnings to cover the dividends. So people say, when you increase dividends, that must mean that you feel more secure about future earnings. Nice story, right? But can you think of a different story where, in fact, a dividend increase can be bad news for a company? Company invested. If NVIDIA announces a big increase in dividends, good news or bad news? Anybody? What do you think?
Could be bad news because that means that they're not gonna grow that as much as they thought they.
In other words, you invest in a great growth. Palantir announces a big dividend. I'm terrified if I'm a Palantir investor, right? Because you think this company has great investment prospects, all these amazing things it can do, and it says, no, we're going to pay a big dividend. So they must know their. You can see already the kind of stories you have to tell for signaling requires you to kind of build these stories built on initially some facts, but then you're building a story on top of it. So the bottom line is, for the most part, dividend increases are good news. But sometimes when a company initiates dividends, it might actually be bad news. This is actually from a study that looked at earnings growth before and after dividends are initiated. So these are the years before, 4 years before, 3 years before, 2 years before, 1 year before. Year of the dividend initiation is peak growth. And then after the dividends are initiated, you actually see growth drop off. So dividends can be good news, they can be bad news. But here's, I think, the most interesting statistic. That study I told you happened way back in time, 30 years ago. It's been updated since. And here's the bottom line from all of these studies. The effects of dividend changes have become more muted over time as you go from the 1960s through this century. Why might that be? Why are dividends conveying less news today than they did 30 or 40 years ago? Where do we get our news now? 30 years ago, you used to open up the Wall Street Journal, and if you were lucky, the company got covered. If it was a big company, a small company, there wasn't much information. It wasn't easy to access equity research reports. There was no Yahoo Finance online. There's basically, your information sources were much more limited. So when a company announced a change in dividends, it carried much more news effect. I mean, it's for the same reason. Where do you get breaking news now? Whether it's in sports or in politics, where do you get your breaking news now? I get it on Twitter. I often hear about something 5 times out of 10, it's fake news, but you still get news mixed in with fake news. And I think increasingly, as our access to information increases, the effects of companies increasing dividends to convey news is becoming less effective. So if you're a company and you come to me and say, look, I want to increase dividends to send news to the market, my advice is, hey, go on Twitter, put out a tweet, the news will probably get out. Why put yourself in this $3 a year dividend just to convey the news? It's having much less effect. So dividends send a signal. I'm not sure whether it's good news or bad news, but clearly markets read into it. There's another reason you might pay dividends, and as I said, it's not a noble reason. Remember this graph I showed you, what happens when dividends go up? Stock prices jump, right? Investors are, at least on average, happy. On that same day, if you look at the corporate bonds issued by the same company, and you look at the returns that happen. So basically, I know it's a tough graph to read, but if the graph drifts up, the stock's doing well, or the investment is doing well. If it drifts down, it's doing badly. So stocks on average drift up. But if you look at what happens to bonds in the same company, they're drifting down. Why, if you're a bondholder in a company, are you affected by the company paying dividends? Kelly, you want to try? If you're a bondholder in a company, why might a company paying dividends affect you as a bondholder? You'd prefer to sit as cash in a company, right? Because they can use it to pay you. If the cash leaves the company, that hurts you as a bondholder. So what's good for stockholders is, do you see how as a stockholder in a company, you can exploit bondholders if they don't protect themselves? You could pay yourself a special dividend, half the company. So what do bondholders do usually if they're sensible? They'll put in covenants on how much can be paid in dividends, if they're sensible. If they're not, then you expose yourself to this kind of payout. So there are good reasons and bad reasons for paying dividends. And in the table, I'm going to end this section with, ask CFOs what they factor in when they decide on dividend policy, from number 1 all the way to number 7. First, so if you look at the statement of, if you look at each of these statements, they were asked, do you agree, do you disagree? A firm's dividend payout ratio affects the price of the stock, 61% agreed, 33%. This is the scariest number in the middle. Because clearly what it is saying, we have no idea. Dividend policy, most CFOs just go along with the rest of the peer group. I'm going to talk about what, because they really have no idea how it affects value. They've been told stories, but they have a sense that these stories don't have sticking power. So let's summarize. When you look at dividends, you can have two bad reasons. One is that bird in the hand fallacy, that your stock will be pushed up just because you pay dividends. That turns out not to be true empirically. The second is we had a really good year. Let's start paying dividends. The danger there is once you get stuck with those dividends, you might have to go out and raise capital in future years to just keep paying the dividends. And three good reasons. You got an investor base that likes what you do, and you're going to stick with it, so you pay dividends. The second is you use dividends as a signal to tell the world, hey, our earnings are a lot more predictable than you think they are. Here's how we'll convince you we're going to go out and raise dividends. And the third is that maybe you're ripping off your bondholders because they left a loophole for you to take advantage of. So now let's turn to the because up till now, we haven't come up with a framework of looking at a company saying, should it pay more dividends, less dividends, should it buy back stock, not buy back stock? So I'm going to give you two frameworks for assessing dividend policy. And in the process, maybe we can also answer the question, is your company the one that should be paying more in dividends, or should it be the one buying back stock? So the first of these frameworks I call the cash trust nexus. Strange word to use in the context of a finance class, right? You're saying trust. I'm going to argue that dividend policy, more than any other aspect of corporate finance, is built on whether you trust the management of the company with your cash. Remember, we started this discussion by saying dividends are your cash. Your stockholders in a company, Apple is holding $200 billion of your cash. Do you trust Apple's management and Tim Cook to do the right thing? That's going to drive what you do about that cash. So we're going to talk about how to measure cash flows and how to measure trust. And the second is to do what we did in capital structure. Look at what everybody else is doing in terms of paying dividends. I'm going to try to do what they do because that way I can't get into trouble. So let's start with that cash trust nexus, and there are three subparts, three steps to this process. First step is an easy one. I'm going to look at your past as a company, and I'm going to look at how much cash you have returned as a company. Have any of you had a chance to look at how much cash your companies have returned? It might not be there, but don't be surprised if your company has returned no cash, right? That doesn't make them abnormal. You might actually be the norm, but your company might have returned cash in either dividends or buybacks. Where would you find this information? In the statement of cash flows. So that's going to be easy, looking at what your company has returned. Second step, we're going to ask, I think, a more important question. How much could my company have returned to shareholders? Sounds like a complex question. It's actually a very simple question. And the answers are right there in the statement of cash flows. We're going to estimate. I'm going to give it a name, free cash flow to equity. Okay? Essentially, it's free because you met every other need. It's a cash flow because I'm going to convert to a cash flow. And it's to equity because that's the cash flow that equity investors can get, potential dividends. And step three, if there's a mismatch between what you returned and what you could have returned, I'm going to ask, does that mismatch hold up, or should we do something about it? So let's start with the first of the three questions, the easiest one, which is how much cash did my company return to its shareholders over the last 2 years, the last 3 years? You're saying, why go back in time? Because with dividends, you might get smooth numbers. Buybacks, since they spike and then they drop, you might want to look at a stretch of time. Here I've looked at 5 years leading into 2013. With each company, I've looked at the dividends they paid back. So you look at Disney, the dividends have increased pretty dramatically. But take a look at the buybacks. Disney in the last 5 years has returned about $19.9 billion, $15.4 billion in the form of buybacks, $4.5 billion in the form of dividends. If you look at Vale, $24 billion in dividends. That's a mind-bogglingly high number. We'll talk about why it's so high. And about $5.7 billion in buybacks. So the buyback disease, if we can call it that, is spreading across the world. Tata Motors, all in dividends. They haven't bought back stock. Baidu, 0, 0. Now, one of the things I want to caution you is if your company doesn't return cash, don't skip the dividend policy section. And give me the reason my company doesn't have dividends, therefore there is no dividend policy. A policy of not paying dividends is still a dividend policy. You have to explain to me whether it makes sense. Baidu doesn't return cash. We're going to come back and take a look at, does that make sense given what they could have returned? And lastly, I look at Deutsche, $4.4 billion in dividends. You can see the drop off in dividends. Clearly something has happened at the company that is getting in the way of them paying dividends. They've been up. So as I said, this is the easy part of dividend assessment. You just get it out of the statement of cash flows, and it captures how much your company could have returned. Now let's talk about free cash flow equity. I'm going to give you an intuitive explanation of what we're trying to measure with free cash flow equity. And the best way to think about it is to be the owner of a privately owned business. So you're the owner, and I'm trying to measure the cash left in the till at the end of the year after you've met every single need. So let's start with how you measure income. You're looking at equity investors. So how do we measure income for equity investors? What measure of income do we start with? What are your choices? Gross income, operating income, net income. Start with net income, right? It's not cash flow. So what's the first step? You add back depreciation and amortization. That makes it kind of operating earnings. Stay in that first section of the statement of cash flows, because right below net income plus depreciation amortization, I'm going to go to Kelly because she's our resident accountant. What comes right below the depreciation amortization in that first section of operating? CapEx shows up in the investing section. Stay in the operating section. There'll be change in receivables, change in payables, change in working capital, right? So basically you have change in working capital in there. Then go to the investing section. You're going to find CapEx. Don't get distracted by the other crap that's in there, right? So it's CapEx, maybe acquisitions. Not quite done. So you've added back depreciation, you've subtracted CapEx, you've subtracted change in working capital. You're the equity investor, right? If you have debt payments due, that's a cash outflow. And if you raise debt, and this throws people off, that's a cash inflow. Think purely like you're running the checkbook. You lend money, you repay debt, that's cash leaving the company. You borrow money, cash comes into the company. Think of that, the net debt cash flow, that's going to be the financing section. You put them all together, you end up with free cash flow equity. Net income plus depreciation, minus CapEx, minus change in working capital, and these net debt cash flows give you free cash flow equity. That is the technical definition. But I'm going to give you two different spins on it because intuitively one of those might connect better. If you take CapEx, depreciation, working capital and put them together, that's what we call reinvestment in valuation. It's what the company's putting back into the company. So instead of treating them as three separate items, you might say, I'm going to have net income minus reinvestment minus this net debt cash flow, which can be either a positive or a negative. So that's one spin. You want to consolidate even more? Take the net debt that you issued, state it as a percentage of the total reinvestment. You can state the reinvestment times 1 minus the debt ratio. Basically, that is your equity portion. In every single scenario, what you end up with. So take a company, try all three. You should get the same answer. It's just three ways of framing free cash flow. So let's pause right there and think a little bit about what drives whether a company will have a positive free cash flow equity, a zero free cash flow equity, or a negative free cash flow equity. Let's start at the top. If your company is a money-losing company, you already know that this is going to possibly be a company that shouldn't be returning cash. It's kind of intuitive, but might as well stay with it. Why? Because you start in the hole, you're going to usually get, unless you have some huge divestitures you're doing. So negative net income, but let's take the more interesting case. You have a company that's making positive net income. What has to happen for a company with positive net income to end up with negative free cash flow equity? The answer is right there, right? What has to be true about this company? Why would a company with positive net income end up with a negative free cash flow equity? Yes, Derek. One is huge debt payments. LBOs, you can make net income, but since you have to pay off the debt, the net debt cash flow is going to be a big negative. That can cause negative. But let's say you don't have much in debt. What else could cause net income to translate into negative free cash flow to equity? Yes. Large capex relative to depreciation. Usually companies with large capex also have large depreciation, right? Large capex, you're saying, when would that happen? If you're a growing company, remember, depreciation reflects capex in previous periods. Capex reflects your much bigger scale right now. We're talking about growth companies. Young growth companies, even when they start making money, will have negative free cash flow to equity. And as you mature, here's what happens. Not that your capex gets smaller, but your depreciation starts to catch up. And when it starts to catch up, that net number, net capex, starts to get less of a burden. You end up with positive free cash flow to equity. You see the life cycle starting to play out? Early in the process, you're a young company, usually money losing. Of course, you're going to have negative free cash flow to equity. You're a growing company, your net income starts to grow, but your reinvestment is high because you still want to invest for growth. You still have negative free cash flow to equity. And you hit that tipping point, you essentially start to see free cash flows to equity become positive. It's a very simple process. It's, basically you're just taking the statement of cash flows and the accountants have their own reasons for breaking things down the way they do. You're just taking those numbers and reframing them from the perspective, what does this tell me about a company's dividend policy? Remember, a statement of cash flows is designed to do what? Explain the change in the cash balance from year to year. That's basically becomes the bottom line. We're saying that's not my bottom line. We're going to look at how much this company could have paid in dividends. So as you look at this process and you look at what happens, especially as you get to steady state, right? Because this you can do for the last 5 years, last 10 years, you can use all three approaches. They will give you the same answer. But remember, your job is to forecast what your company can afford to pay in the future. So let's start at the top. You got to forecast net income, right? You go get growth rates from somewhere, forecast net income. CapEx, depreciation, working capital, maybe consolidate them and say, this is a growing company, 80% of my net income goes into reinvestment. So you want, when you forecast things, to keep it simple. Less is more. And in fact, if you're forecasting free cash flow to equity, I would just forecast 3 items: net income, reinvestment consolidated, and a debt ratio. Saying, over time, I expect to raise 30% of my reinvestment from debt, 70% from equity. So there's the shortcut. Net income, subtract out the net capex times the equity portion of that, and change it gives you a free cash flow to equity. And you can compute that fairly simply if you want to for the future. Why do you want to do that? To get a sense of how much your company can return in cash flows in the future. So that's the way we compute free cash flow to equity. Any questions intuitively about what we're trying to do? This is the cash left in the till. You can take it out of the company without hurting the company's value and prospects. That's key. You can always take out more, but if you do, you got to go back and tell me how much lower your growth is going to be because you took out too much cash. So for Disney, I computed the free cash flow to equity from 2008 to 2012. Start with net income. So this is our actual free cash flow to equity. I'm not forecasting. There's the net income over the 5 years. There's the net capex over the 5 years. And you can see it. Net capex is a hugely volatile number. And that's something you're going to start to see when you look at reinvestment. It's not this nice, smooth number. Some years you reinvest a lot. Some years you don't reinvest very much. And that's one reason I'm looking across a period of time rather than 1 year. There's a change in working capital. Again, directly out of the statement of cash flows. There's my free cash flow to equity before I even look at debt. I don't know how many of you track Warren Buffett's writings, but one of the things that Warren Buffett talks about is what he calls owner's earnings. And his definition of owner's earnings is net income plus depreciation minus capex. So it's very close to this free cash flow to equity. He ignores working capital because he thinks it's too volatile a number. For many companies, that difference is going to be narrow enough. If you're a retailer, it could get you into trouble. But he doesn't factor in debt. His argument is a healthy company shouldn't be drawing on debt to pay dividends. I disagree with that. A healthy growing company should be borrowing money to fund its reinvestment. It's not borrowing money to pay dividends. but he stops at that free cash flow. So I just to give you a sense of what that number would look like, it's $17.3 billion if you didn't factor in debt cash flows. Over this period, though, the net cash flow from debt has been positive for the most part. What does that mean? That Disney has been borrowing more money than they're repaying, which is actually usually a sign of a healthy company. A healthy company, as it scales up, should be borrowing more money than it's repaying. And the net debt adds another 9.8 billion. So if you add that on to the 17 billion, you get $27 billion in free cash flow equity. The one reason Disney was borrowing so much, it was under-levered to start the process. And remember, if you're under-levered, you should be borrowing more money. So I tried a different calculation where I said, if I just used a target debt ratio, 11.58%, which is where they are, and used that to fund my reinvestment, what would my free cash flow equity be? Be about 18 billion. So I've got three different measures of free cash flow equity. 17.3 billion if I don't count debt cash flows at all. 27.1 billion if I count all of the debt cash flows, but they were borrowing a lot of money during this period, or the 18 billion plus, which is kind of a smoothed out free cash flow equity. They actually returned $19.9 billion. So they returned about $1.6 billion more than they brought in as free cash flow equity. Is that a game breaker of company this size? It's not that large of a difference, but it does mean they're returning all the cash they can and more, at least over this 5-year period. So that's basically what you're trying to do with free cash flow equity. Look at what your company could have paid out, look at what it actually paid out, and then say, what do we do next? I want to take a little pause though and talk about what happens when companies have large free cash flows to equity and they don't pay them out. In the late 90s, Microsoft was on its way to becoming the largest market cap company in the world. GE was still larger, but it was just rising. And in 1996, they had net income of 2.2 billion. Their capex was 494, the depreciation was 480. If you take that net number, it's 14 million. That sounds like an absurdly low reinvestment, right? But what am I missing when I look at just that 14 million? What's Microsoft's big reinvestment in? CapEx captures land, building, equipment, factories, but that's not what Microsoft's reinvests in. It's R&D, and net income is already after R&D. So in a sense, it's a little deceptive. It doesn't throw off my free cash flow equity. My net income is understated. My reinvestment is understated. The net number is still the net number, but that's a 14 million net capex. The change in working capital is 35 million. Again, a tiny number. You net out net capex and change in working capital, their free cash flow equity was $2.127 billion. And at that time, that was a huge free cash flow equity. Everything scaled up today. They paid no dividends, and they bought back no stock. So I have a very simple mechanical question. If you have $2.127 billion in free cash flow equity, and you pay no dividends, and you buy back no stock, where would I find that $2.127 billion on Microsoft's financial statements? Yusuf, you want to try? That's the answer you usually get, but the wrong side of the balance sheet, right? What's retained earnings? It's net income minus. So on the liability, you're right, book equity will rise, but not by 2.127 billion. Where do you think it'll go? Yep.
Cash.
There's only one place it can go. On the asset, it has to go into cash. You're saying, why can't it go into R&D? Because I start with net income. Net income is already after R&D. Why can't it be in CapEx? Because I've already netted out CapEx. The only place it can go is into the cash balance. So the cash balance at Microsoft increased by $2.1 billion in 96. In 97, they had $3 billion in free cash flow equity. They returned nothing. So that's another $3 billion on top of what they had before. 1998 was a big year, $5 billion. You're saying, why was it a big year? Go back and look at all the Windows years, Windows 98, because that used to be their core business, right? Every time you did an upgrade, they got $5 billion in free cash flow equity, paid out nothing. Another you see what's going to happen, right? 2 plus 3 plus 5, and each year you keep building up. By the time you get to 2000, Microsoft had the largest cash balance in corporate history at that time. It was about $40 billion. But when you see companies end up with big cash balances and CFOs claim to be surprised about how it happened, my response is, what do you think? It's manna from heaven that landed up on your balance sheet? This is a direct consequence of not paying out what you can afford to. I'm not passing judgment on whether it's good or bad yet, but we know how Apple ends up with 200 billion cash. And to give Apple credit, Apple has returned $500 billion in buybacks over the last 6 years, and still its cash balance goes up. That's a great problem to have as a company, right? You keep funneling out cash, but more cash keeps coming in. Apple's trying, but its cash balance is rising because it's free cash. It's a cash machine. The iPhone is the greatest cash machine in history in terms of how much cash it has created for Apple as a company. So when you look at free cash flow as equity and you don't see that cash return, there's only one place for it to go. The cash balance builds up. Remember I said last session that a lot of tech companies don't start to pay dividends even though they can afford to because they want to be young again and be growth companies forever. You look at big tech companies, almost every one of them. Google has 100 billion. Some of them try now. They try to return. Facebook and Google, in fact, this year initiated dividends. And I think I've said this before. When a growth company initiates dividends, it's like when you decide to switch from jeans to khakis. You're sending a signal out saying, you know what? I'm shopping at the Gap from now on. And I'm too old for this stuff. Okay? It's a signal to the world. I am middle-aged. There's nothing wrong with signaling the truth. And it's actually good for Google and Facebook to do it because what are they trying to do? Bring down unrealistic expectations on the part of investors who think they can grow. I mean, when I hear people saying Apple can grow 20% a year, in what universe is that going to even happen? Maybe they can pull it off for 1 year. These companies are great cash machines, but their growth rates are leveling. In fact, they're great cash machines precisely because their growth is leveling off. Do you see the connection there? Because your growth leveling off means you reinvest less. If you reinvest less, you have a higher free cash flow equity. Now, the question is, can you compute the free cash flow equity for a bank? Do you remember our discussion of capital structure for a bank? What do we say? You can't tell whether a bank has too much debt or too little debt, but you can tell whether it has too much equity or too little equity. Relative to what? To regulatory capital. In fact, we defined what a bank can borrow by looking at how much it has to set aside for regulatory capital. I'm going to stick with that theme. If you ask me to estimate the free cash flow equity for a bank, I'm going to start with net income. That's still the starting point. But rather than look at capex and depreciation and working capital, which will take me nowhere for a bank, I'm actually going to look at how much they will have to invest in regulatory capital as a bank. And that's going to become equivalent of reinvestment. That's it, I'm done. Net income minus reinvestment in regulatory capital. Let's step back and think about what kinds of banks then can pay out high dividends and what kinds of banks can pay low dividends. High growth banks versus low growth banks. Which should pay the higher dividends? And what is it about the low growth banks that allows them to pay high dividends? The regulatory capital doesn't have to rise much, right? Because if you're growing 2% a year, your regulatory capital needs are going to be small. So other things remaining equal, let's see, you're saying that's pretty obvious. Banks are often classified based on their capitalization. Undercapitalized versus overcapitalized bank. And let's be very clear, when we talk about under or overcapitalized bank, we're talking about regulatory capital or equity capital. So let's say you're looking at a bank that is undercapitalized versus one that's overcapitalized. They're both mature banks. You can already see the consequences, right? If you're an undercapitalized bank, even though you're not growing, you have to come up with investments in regulatory capital to get back to steady state. You can essentially see the effect on your reinvestment, your free cash flow equity. Let's take a third scenario. Let's suppose that the Fed increases regulatory capital requirements for all banks. What is it going to mean? all banks are now going to have less free cash flow equity than they used to. They can continue to pay dividends like they used to, but they're going to get into trouble if they do. It gives you a way of thinking about how much can banks return to their investors, and the free cash flow equity will therefore vary across banks. And because when you talk to equity research analysts, they say banks can return their earnings as dividends. No, they can't, because if they did that, they'd have regulatory problems, especially if the growing banks or undercapitalized banks. So with Deutsche, I actually looked at the free cash flow equity, and you can see that the bank is in deep trouble, right? You look at the each year, and this is based on, so this, I'm forecasting free cash flow equity, because they were already in trouble and saying, and they were paying dividends, and it made no sense to me because everybody knew they were in trouble. And when you compute the free cash flow equity, it was negative. We'll talk about why companies with negative free cash flow equity might continue to pay dividends, but they were. So I forecast out the free, and this is an optimistic scenario. You can see they will need to invest huge amounts in regulatory capital to get back to steady state, which means that free cash flow equity will continue to be negative for the next 3 years. Eventually, can they pay dividends? Yes, if things work out. But banks in particular, I think, have some of the most insane dividend policies in the world, where they get stuck paying dividends. And I'll give you all the reasons I hear from bank CFOs as to why they can't afford to cut dividends and why they shouldn't be cutting dividends, especially when everybody knows they have negative free cash flows equity because of the regulatory capital needs. So every year at the start of the year, when I do my data analysis, one of the things I do is I compute the free cash flow equity for every company in the world. Sounds like a lot of work, but it's just a column in the Excel spreadsheet, right? Net income plus depreciation minus capex, minus change in working capital minus net debt cash flow. So I compute the free cash flow equity for every company. Then I look at the dividends and buybacks in that same statement of cash flows, and I compare the two numbers. What am I trying to figure out? Are companies paying out less than or more than they can afford to? And I've broken it down by region, and make of it whatever you want. So first, I broke companies down based on whether they made money or lost money, and looked at what percentage of each group paid dividends. I mean, even without looking at the statistics, saying, why would money-losing companies pay dividends? No, it is true, money-making companies are more likely to be dividend payers than money-losing companies. But if you look across money-losing companies, that number is definitely not zero. There are lots of money-losing companies that continue to pay dividends. I also broke companies down based on free cash flow equity, positive, negative. And remember, we said negative free cash flow equity shouldn't pay dividends. Again, the overall statistics support the idea. Companies with positive free cash flow equity are more likely to pay dividends than companies with negative free cash flow equity. But a significant percentage, globally, 36% of companies with negative free cash flow equity are returning cash to their shareholders. So let's look at these disconnects, right? First, let's look at why a company which is money losing might continue to pay dividends. And I'll list out reasons, and they range from sensible to not so sensible. First is inertia. What does inertia capture? Why are these companies paying dividends? Because they've always paid. ChatGPT is running the company. It's looking at last year's dividend paid this year. Why I'm paying money to have a CFO in the company completely, I don't even see the point here. It's inertia. It could be that they worry about sending a bad signal. Remember that picture I showed you? This is actually the argument that bank CFOs often give for why they don't want to cut dividends in the face of calamity. 2009 was a horrifically bad year for US banks. Every one of them is in trouble. 75% of US banks continued to pay dividends in 2009. I remember talking to the CFO of a pretty large bank. I said, why are you guys paying dividends? Everybody knows you're in trouble. He said, we don't want to send a negative signal. I said, what universe are you in? Every day I open up the Wall Street Journal, I get the news that, when you pay a dividend, what it tells me is you're in denial rather than anything else, because everybody knows you're in trouble. Signaling the truth is never wrong. In fact, if you're in trouble, it's better to take your medicine, say, we can't afford to pay dividends, but they hold on. The third argument is they hope for a bounce back, right? We talked about commodity companies, you bounce back. So, okay, if you're a company in a cycle, in a business that's cyclical. And the fourth, and this goes with the second reason, is everybody else pays dividends. I know we're in trouble, but we don't want to be different. This sounds like a 6-year-old is running the company, right? And a lot of dividend policy, you look and say, is there a grown up in this room? But it's almost like dividend policy is set by looking at the peer group and doing what they do. So that's money losing companies that pay a dividend. Let's look at the other side of the spectrum. Why would a money making company not return cash to its investors? First is inertia. Again, why are you not paying dividends? Because we've never paid dividends. Okay, that's deep. I'll take it and move on. The second is, and this is a more sensible thing, is net income is profits. We need to reinvest to grow. And we're reinvesting so much that after we reinvest, we don't have cash return. Remember, we're talking about income, not free cash or equity. The third is my income looks good now, but I don't want to return cash because there's a tariff coming and who knows what my earnings will look like next year. The fourth is, remember, when cash leaves the company, you no longer control it as managers. To be honest with me, as a manager, isn't it nice to be sitting on 200 billion? Everybody pays attention to you, especially bankers. You give that cash back, it's out of your hands. This goes back to that first discussion we had on corporate governance. How much power do you have as managers? And I will wager that in markets with poor corporate governance, more cash is held back by companies because you really can't get to the cash. So that's net income and dividends. Let's focus on free cash or equity. Again, why might negative free cash or equity firms return cash? Again, inertia. Hopes for a bounce back in the free cash or cyclical firms. The third is actually something to think about. Remember, this follows our analysis of whether you have excess debt capacity. If you're an underlevered firm, what does that mean? Your actual debt ratio is well below the optimum. One of the ways you might be able to push your debt ratio up is by returning more cash than you have available in free. It actually makes sense because over time your equity will shrink, your debt will go up, and your debt ratio will go up. So capital structure and dividend policy are actually connected on that basis. So when you look at your company's dividend policy, also look at, do they have excess debt capacity? And finally, if you're in that portion of the life cycle where your best days are way behind you, then maybe the best thing to do is make yourself smaller over time. And that if you return more than your free cash flow every year, you're partially liquidating yourself every year and making yourself a smaller company. So that's why negative free cash flow equity sometimes return cash. Let's talk about why positive free cash flow equities sometimes don't return cash. One is, again, inertia. Second, did I copy the same thing here? So again, the bounce back effect in the other direction, right? Which is my free cash flow equity is positive right now, but what happens if I have a bad year? So essentially, it's the opposite of the bounce back argument. Third is if you're over-levered, if you conclude your firm is over-levered, when you get positive free cash flow equity, you don't want to return it to your shareholders. You want to use it to pay down debt because that becomes your first priority. And finally, if you have expansion plans, you want to keep that free cash flow equity for that big investment you got to make, the acquisition you're going to make a year or two from now. So as you look across companies, and especially as you look at your own company, when you look at that free cash flow equity over time and what your company returned, you'll almost never see that perfect cash return where your free cash flow equity gets returned. Your company will either return too much or return too little. Okay? And don't be too quick to judge them because you got to look at that in the context of their, what their earnings do over time, what their capital structure looks like. But cash return and free cash flow equity can be mismatched. So we talked about what happens when a company has big free cash flows equity and it doesn't return the cash, right? Your cash balance builds up. Apple, it's $200 billion. But investors seem to be okay with it, at least for the moment. And I'm going to add that on every time I say investors are okay for the moment, because that can change. But once in a while, you'll accumulate cash as a company and investors are not going to be okay with it. So I'll take you back to the 1980s and look at a company that used to be called Chrysler. God only knows what name it is called under now. No. Stellantis. How you come up with who? I mean, they probably paid millions of dollars for this name. Who'd want to buy a car made by Stellantis? You know? But I guess they thought it was some neat name, made them sound technical. Chrysler in the early 80s almost went bankrupt. It was one of the first bailouts. In fact, the US government bailed out, one of the first corporate bailouts in the US. And in 1985, it actually was starting to, it got a new CEO. It had zero cash balance. Its cash balance had gone down to zero. The new CEO's name was Lee Iacocca. And he reinvented the company around a vehicle that I still curse every time I pull into a mall. You know what Chrysler created that allowed it to make a comeback? The Dodge Caravan. The first minivan. I mean, if you want to see what minivans look like pre-Dodge Caravan, take a look at the old Volkswagen buses. It's basically you threw people into the back. I don't even think there were seats. You hope they didn't get too hurt as they got thrown around. But the Dodge Caravan reinvented Chrysler, and Chrysler rode it to success. So in this graph, here's what I've done. I've taken the net income each year. That's a white column. And the black column is the dividends they paid each year. So 1985, they had 1.5 billion in free cash flow equity and paid out very little in dividends. What happens to your cash balance? So each year, what I'm doing is tracking the free cash flow equity and dividends, taking the difference, putting it into the cash balance. So over time, their cash balance goes up. There was a recession somewhere in the middle, but they kind of made it through. And by the time you get to 1994, Chrysler had accumulated a cash balance of $8.5 billion. That doesn't sound like much relative to what Apple has, right? 200 billion. But at that time, Chrysler's entire market value as a company was about 30 billion. So think about what you have. More than 25% of the company was cash. And a guy called Kirk Kerkorian noticed the cash. I still remember because, you know, he called a press conference and he's, in the entire tenor of the conference is Chrysler has too much cash. They need to return the cash. Of shades of what Carl Icahn does at a lot of companies, right? You have too much cash, give me the cash. What do you think Chrysler's response to that was? No, this is not too much cash. And they gave a bunch of reasons, most of which didn't stand up. First, they said, we're a cyclical company, we need the cash. What part of that statement is true? Cyclical company is true. But do you need $8.5 billion in cash? In fact, you can very quickly start to debunk how much they need because there is a recession during this period. And how much cash did they burn through? They started about 3 billion, they got to 200. So they burnt through about $500 million in cash in the last recession, which lasted 2 years. So let's do an algebra problem. If the last recession lasted 2 years and you burned through $500 million in cash, how long does the next recession have to last for you to need $8.5 billion in cash? Like 34 years. So you're planning for a 34-year recession. That's what you're doing. It's like a guy who goes into his backyard and starts building an ark every time it starts drizzling, saying this could be the big one. I can understand. You're a cyclical firm. You want to hold $1 billion in cash, maybe $1.5 billion. $8.5 billion is way too much. So they very quickly realized this wasn't working. So they came back with a second reason. They said, we might need it in case we decide to do a big acquisition. This is making you feel a lot better as Chrysler shareholders, right? What's the history of companies doing big acquisitions? We kind of talked about it at the start of the class. What do? They get great bargains or they overpay? In fact, no, in my valuation class, I'm going to do a session on acquisitions. The title of the session is Acquirers Anonymous, 7 Steps to Sobriety. Because acquisitions are like an addiction. You buy a company, you stop taking projects, right? It's so much work. You take one big acquisition. That didn't work very well either because people said, we don't want you to be doing a big acquisition. You can't build an assembly plant. How the heck are you going to buy an entire company? The bottom line was finally Chrysler had to give in. They gave, Kerkorian a seat on the board. They returned more than half of the cash to their shareholders. But the point here is they came under pressure because of who they were. They were Chrysler. And they were in a business, the automobile business, where people realized there wasn't much in terms of growth. This is not a great business to be in. And already you can see the setting. Microsoft in 2000 had 40 billion cash. Nobody brought that up as a big cash balance. Why? Because they looked at Microsoft's history, they looked at the business, which is still a growing business, say, in this company, I'm okay with Microsoft holding my cash. They look at Chrysler with 8.5 billion cash, they come to a very different judgment. That's the trust part. If you trust management to not waste your cash, you trust management because the company's in a good business, you trust management because they have a good track record, you're more likely to cut them slack in terms of how much cash you will allow them to have. Conversely, if you don't trust them, then everything starts to come apart at the seams. You trust Facebook with your cash. It's ebbed and flowed, right? Early on, what was the view? Mark Zuckerberg is a genius. Look, he wears a sweatshirt for his IPO. That must mean he's a genius. Right? And for the first 6 or 7 years, founder worship kicked in, right? Great CEO, great. And then he did the metaverse dance, and people said, this guy has no idea what he's doing. He likes to spend a lot of money, and he's not telling us what to do. Period. In 2021, where people have said, give me all the cash back. We don't trust you with the cash. That was the absolute bottom. And to give Facebook credit, you know what they did right after, right? They did a big stock buyback, say, you guys are right. We have no idea what we're doing, but we're going to re-earn the trust. And he has, by being much more careful. If you notice, he doesn't talk about the metaverse much anymore. Even AI is a lot more muted than he might have been 5 years ago. Because that's why I think we need to give this guy credit for being somebody who senses what markets want and changes his tune rather than going like a bull in a china shop. It's about trust. So if you ask me, is my cash balance too large? I'm going to say, do investors trust you? If they trust you, they're going to let you hold the cash. It does. I mean, I'm an Apple stockholder. You know why I feel okay with Apple holding 200 billion in my cash? How many large acquisitions has Apple made in the last 10 years? None. Not one. You're saying, what about Beats acquisition? You know what it cost them to buy Beats? Like $5 billion. It's like petty cash. Nobody probably even noticed. Oh, 5 billion left. We have so much cash. No, just let it go. Can you imagine how much pressure Apple must be under to acquire companies? They probably built a moat around one infinity loop to keep bankers out. Because there are probably teams of bankers with another target for them. We got a perfect company for you. And that is amazing discipline for a company to not do it. And what did they do? With AI, you see the same kind of discipline, right? What's Meta doing spending $60 billion? Microsoft, 75 billion. Apple says, wait, do you really think this is going? And people take issue with them. You're being too cautious. I think what Apple is doing in AI is, in fact, the better strategy, because why jump in before you even know whether you need these big AI chips? What if DeepSeek is really the way to go? With low-grade chips and less data, you could deliver 95% of what you want. The reason I trust Apple for the moment is because they haven't done anything stupid. If tomorrow they announce they were buying Tesla, they could. Maybe the price drops another $50. Then I'm out of the door, right? Because in a sense, that's where trust gets broken. In big acquisitions where management says, trust us, we know what we're doing. My response is, no, I came close to selling Microsoft when they bought Activision. The only reason I didn't was Activision was small at 76 billion. Saying 76 billion is small. When you're a $2.5 trillion company, 76 billion becomes small. But it was a bad acquisition. In hindsight, I don't think it helped Microsoft any, but they got caught in because they got started the deal. It's tough to walk away. So here's what I'd like you to do for your company. And as I said, this is the simplest of the different things you got to do for the class. Estimate the free cash flows to equity for your company. Stay with that statement of cash flows. And the statement of cash flows, remember the sign is already there, right? So CapEx will have a negative in front of it. Don't, so basically in the statement of cash flows, you just take all of the numbers and accumulate them. It'll take care of itself. Look at what your company could have returned. And then look at what it actually did return. And say in the same statement of cash flows, the repurchase of stock and the dividends will be in there. And do it over maybe 5 years, 3 years. If your company's been around only 3 years, do it for those 3 years. You have no choice, but it's been around longer. Look across time. You want to look at trend lines. You can look at what the company can, because you're trying to get a sense of what is my company's policy. So I'm going to set up a framework for assessing dividend policy, and maybe this will help you with your company. So let's say you compute the free cash flow equity for your company over 5 years, 10 years, whatever you want to do. Then you look at what they actually return in the form of dividends and buybacks. One of three things is going to be true once you've done that computation. One is your company is one of those very rare companies that actually returns its free cash flow equity to its shareholders, either as dividends or buybacks. Con Ed, for instance, returns about 97% of its free cash flow equity to its shareholders. But that's the exception. You're going to have one of two cases for most of you. Your company can either be paying out too much in dividends or too little in dividends. Let's take each and play it through. And let's look at whether you'd push the company to change what it does. If it pays too much in dividends, then ask a follow-up question. What kind of investment opportunities are there for this company? You can look at the return on capital you computed, 7 sessions ago for your company, and look at it versus the cost of capital. But make an assessment. Am I in a growth business or a mature business? If you're in a growth business and you have great investments, then my advice to the company is go out and take good projects. And, because if you pay too much in dividends, essentially, you're going to have that. But if you pay too little, I'm essentially going to cut them slack, saying you're going to find good investments, hold on to the cash. But if your investment history is checkered, you haven't earned your cost of capital for the last 10 years, you're accumulating cash. This is just common sense. You're going to put pressure on this company, right? So don't pick on Carl Icahn when he does that for you, because somebody's got to be the bad guy in this process saying you guys need to return the cash. So if you have accumulated cash because you paid too little in dividends, the key becomes, are you in a good business and do I trust you as a manager with your track record? If I do trust you, I'm going to let you hold on to the cash. And if I don't trust you, I'm going to try to put pressure. And if I don't, I'm praying and hoping that Carl Icahn will put the pressure on you to give the cash back. So that's if you pay too little in dividends. Yeah. If the company, if you pay too much in dividends, let's see what the consequences are. Again, I'm going to ask you, do you have good projects? If you have good projects and you're paying too much in dividends, you're doing double damage to yourself, right? In addition to creating this cash deficit, you might be rejecting some of those investments because you don't have the cash. Here, I'm actually going to actively ask you to invest, pay out less in dividends and redirect that money to those good investments. Why? Because then I get the net present value of the projects and you no longer have a dividend problem. And there's a final scenario. Let's say you're paying too much in dividends and you're in a bad business. See why there's no easy advice to give you? Ask this company to cut dividends. What are you afraid they might do? Take the cash and put more into the bad business, right? This company has a problem, but it's not a dividend problem. It's an investment problem. If they don't fix the investment problem, fixing the dividend problem is going to be cosmetic, right? You cut dividends, you're going to be back into the problem because you keep taking bad projects. So here you got to do two things. One is you got to go back to the investment section and say, hey, the way you pick projects is not working. You're taking a lot of bad projects. Cut back on that. Maybe that'll make your dividend problem go away. And if it doesn't, cut dividends. So let's summarize. Your company pays too little in dividends. It has great projects. You trust the management. You're going to give the company a pass. You can say this company has a big cash balance. I'm okay with that, the Apple scenario. Your company pays out too little in dividends, it has bad projects, then you're going to push for the cash to be returned. So this is the scenario where activist investors put pressure on you to return cash, or you put pressure. If your company pays too much in dividends in great projects, you try to get the company to return less cash, even though everybody else in the peer group might be paying those dividends, and you invest more in projects. Your company pays too much in dividends, there's bad projects, it's got to fix its project problem and the dividend problem together, or it's going to be back into that same problem. So that's a framework I'm going to use, and I like to think of it in terms of a matrix, where basically on one axis, I have whether the cash returned is less than or more than the free cash or equity, and the other one, whether you have good projects or bad projects. So let's see what quadrant you would put Apple in. Good projects, yeah, you can look at the track record. The company earns 30, 35, 40% returns. Cash return, less than free cash or equity, yes. But I'm not worried about it because I'm going to give them the maximum flexibility because they've earned that flexibility. You go to this quadrant right across, you have a cash deficit and poor projects. Think of this as your worst possible quadrant. Because here you have two problems. You have a dividend problem and even investment problem. And unless you fix both together, you're going to be back into that same problem. The other two quadrants are the interesting ones, because if you have a cash surplus and poor projects, that's the kind of company going to put pressure on the company to give the cash back because you don't want that money going into poor projects. And if you have cash deficit and good projects, you want that cash to go into the projects. Right? And if you're paying too much in dividends, that prevents you from taking projects. You're going to ask them to cut dividends if you can. So what I'd like to do actually is take you through each of the companies I'm analyzing, and I'm going to ask you to play the role of shareholders in the company. And I'm going to play the role of the CEO of the company. And I'm going to get up in front of you and say, trust me. And I'm going to let you make the judgment on whether you would trust me. Okay? So, Microsoft in 2000, I said, had a $43 billion cash balance, largest cash balance at the time. And there was no real pushback against them. Because they had a history of delivering great projects. And then things changed when the Justice Department actually targeted them. This was 23 years ago for a breakup. They got very close to breaking up Microsoft into Office and Windows as separate companies. It didn't come to fruition. But that changed the dynamics because people start to worry about cash and what Microsoft would do. And to give Microsoft credit, in 2004, they paid a special dividend of $33 billion. At that time was the largest dividend paid by a U.S. company in history. What I'm trying to say is good companies respond to market pressure, not by lecturing the market on how short-term it is, but by saying, guys, and that's why I liked what Facebook did in the aftermath of the metaverse. They said, we screwed up. And here's how we're going to show we screwed up. We're going to return some of your cash back to you because it's your cash. And we'll try to earn the right to get that cash back by returning to taking good investments. So let's start with Disney in 2003. Long time ago. But if you remember, this was when Michael Eisner was still CEO of the company. So you guys are shareholders at Disney. It's 2003. I'm going to set the table. Between 1994 and 2003, Disney generated $969 million in free cash flow equity over that cumulated period. They returned $639 million in dividends and buybacks over that same period, right? So you take that difference, $330 million every year that they're holding back. $330 million times 10 years is going to give you $3.3 billion. You add interest on top of it, you're very quickly getting to $4 billion. So by the time you come to this annual meeting, Disney has accumulated about $4 billion in cash. It's your cash, right? So I'm going to be Michael Eisner. I'm going to get up there and ask you to trust me with your cash. In a moment of, you've seen the Jim Carrey movie where he can't tell a lie. If you've never seen it. Let's say Michael Eisner has the same disease. He gets up there, and without meaning to do it, he also reveals what he's done for the last 10 years, which is over the last 10 years, Disney's generated return on equity on its projects about 2% less than its cost of equity. It's also under-delivered, under-delivered on its stock. So its stock price has underperformed the market. Its return equity is less than the cost of equity. And I'm the guy who's been in charge of the company for those 10 years. So what I'm asking you to do? To trust me. Remember this, you can make judgments on either side. I'm sure there'll be disagreement. But I don't have a strong hand here. Because my track record is going to, in fact, if you add on top of it, two things. One is that during this period, Disney did an acquisition of Cap Cities ABC, which completely blew up on them, driven largely by Michael Eisner's ego. You got the setting for a blowback. In 2003, I'll wager if this had come up for a vote, if you could actually vote on dividend policy, which you're not, my guess is shareholders said, give me the cash back. And the fact that it's Michael Eisner would have made it more likely. You know what the lesson for this is? In good times, CEOs sometimes treat their shareholders with contempt. Why? Because they don't need them, right? Burns. It'll come back to haunt you because there will be a time when those shareholders will pass judgment on you. So your job as a CEO in the good times is treat your shareholders well, treat them with respect, because then when times are bad, you can say, hey, no. And the more you let your ego drive decisions, the more likely you're going to be in Eisner's place. There's 2003. Disney had lost all control of its dividend policy. Investors were putting pressure, they had to return more cash. Eventually, this ended up with Eisner leaving the company, getting pushed out, and was replaced by Bob Iger. So let's fast forward to 2000. So in 2003, the bottom line is Disney had no control because of the decisions they'd made leading into 2003. Zero control over dividend policy, lots of pressure to give the cash back. Fast forward to 2009. New CEOs come in. And at least in the early years, Bob Iger did all the right things. Remember, he shrunk the board from 17 members down to 10. He made it more independent. He actually listened to shareholders, seemed to have this small ego. And he'd announced that he was going to retire in 2011 or 12 because he felt that that was the right time. In hindsight, turned out to be not true. But so in 2009, he looked at the company. It had a new CEO. Its stock price performance had improved fairly dramatically between 2003 and 2009. Its return on capital and return equity had risen above the cost of equity and capital. And now, as Iger, I'm going to come in front of you and say, look, for the last 5 years, I've been returning more cash than I've available as free cash for equity. I need this cash to build new theme parks in China because that's where the growth is going to be. We need more money because we want to buy other movie studios, like Lucasfilms was still being talked about. And I gave you the chance of voting again. My guess is most of you would act differently in 2009 than in 2003. What I'm trying to say is companies earn the right to hold cash for a while. But you have to earn the right. Nobody's endowed the right. So when managers act like the cash is theirs, and that shareholders asking for the cash are somehow doing a disservice, they're missing the point. You earn the right to hold cash. And if you lose that right, then you got to earn it back again. So 2003 to 2009, you can see the shift. And the shift happened because of performance, because the Jensen's alpha that you computed 10 weeks ago comes into play. The return on capital comes into play. So if you have a company with a negative Jensen's alpha and a negative return on capital, less than the cost of capital, this part of the analysis is going to become pretty much of a slam dunk. This company is not going to be trusted. And there's going to be pressure on it to return cash. They might not have to, but that pressure is going to build up. 2013, things start to shift again. Why? Because remember that 2011 retirement had come and gone. Iger was back again. The corporate governance was starting to get shaky. The board was starting to become an Iger board again. Okay. I think that if Iger asked you for permission in 2013, you'd be less eager than in 2009 because you're saying, we don't feel as secure about your judgments here. What do you think about Bob Iger in 2025? Where does he stand in terms of trust, you think? First, he left right at the heart of COVID, right? He claimed he was leaving. I don't even know what the reasons he gave to have a restful life. I think he kept his office in the Disney building in Burbank, which is not a good thing to do if you're a CEO that claims to be leaving. And then he anointed Bob Chapek as his successor. And then 2 years later, he was back. And Disney is kind of changed as a company. The entertainment business is now broken officially. Nobody knows how to put it back together again. Disney Plus was out of control, and this, of course, gave rise to that activist investing push you saw in 2020. I think Iger has responded well to it because he's cut back the money spent on far fewer shows in Disney Plus than they used to be. He's kind of responded in the right ways. Some of the pressure is off, but you can see that Disney is on probation, right? They're being watched. And I think that Iger knows that. And of course, what's the next big date for Disney? When does Iger, what does Iger said? When is he claiming he's leaving? What year? I think 2026. He said, I'm gone in 2026. We'll see if that holds. My guess is if that doesn't hold and he's still around in 2028 or 2029, we'll have a problem again at Disney. And basically with the company, you can see these ebbs and flows over time, where when people trust you, you get the right to accumulate cash. When people don't trust you, you're going to see pressure on you either from investors or activist investors. And if you're a good management, you got to kind of respond to that trust without getting defensive, because when people lose trust in you, you can't talk them back to trusting you. You got to deliver. And I think that's what Disney has to do now in terms of earning that trust back so it can go back to accumulating cash and controlling its own dividend policy. Take a second company, Vale. It's been a long time, so let me remind you again what Vale does. It's a mining company. It's a Brazilian company. It used to be owned by the Brazilian government a while back before it was privatized. And if you remember the corporate governance structure, Vale has, two classes of shares, voting and non-voting shares. And on the non-voting shares, which are called preferred shares, it has to pay a fixed dividend. And if it fails to pay that dividend, then it has to give those shareholders voting rights. So keep that in the background, because Vale definitely has a dividend problem. It's a huge dividend problem. Its free cash flow equity, even if you give it the best possible spin, it's negative if you just use the actual debt ratio. If you use the target debt ratio, it's about 13 billion, but they're returning about $30 billion cash, mostly in dividends. It's not even debatable. The company is paying out much more than it can afford to in dividends. And it's not under leveraged. So you can't even look for that escape hatch. Remember, it was over levered when we did the optimal debt ratio. Everybody at Vale knows there's a dividend problem. So I'm going to be the CEO of Vale. You're going to be Vale shareholders. And I'm going to get up there and make a plea, which is, guys, we can't afford to pay these dividends. We're going to cut dividends. But most of you own what kind of shares? Those preferred shares where you get no voting rights, right? You run some quid quo pro, I would think, from this process. I want to cut dividends. What would you like in return? Some voting rights, right? Essentially, I'm asking you to trade off. Do you want to continue with this insane dividend policy, which you can't afford, or do you want to give up some control? Guess what companies consistently seem to pick? Pick control. They'd rather drive themselves into the ditch, paying out dividends they can't afford to, than give up voting rights to the preferred shareholders. Petrobras had this problem multiplied. It almost went bankrupt because it continued to pay dividends, which it couldn't afford to. But it becomes this contest between, do you want to give up some control and get back to sanity on your dividend policy, or do you want to keep control and keep paying these dividends? Companies consistently seem to pick control. So Vale is actually a classic case study. What happens when you have different class of shares, and dividends are essentially what are keeping the non-voting shares non-voting, and you can't afford to pay those dividends, you might never see action this lifetime. Just as a tangent, there are a couple of countries, Chile, I think, had for a while, where companies, and in Europe, they were talking about this. I think in one French election, this was one of the big issues. One of the candidates wanted to mandate that every company had to pay out 35% of its earnings as dividends. I don't know what passes through politicians' heads when they think about dividend policy, but let's think through the consequences of what will happen if you make every company in a market pay out 35 or 40% of its earnings as dividends. Take the US market. Let's suppose the law is passed that every company has to pay out 40% of its earnings as dividends. You say, why would I want to do that? God only knows. Maybe you want to collect more in taxes. Maybe you have some weird explanation of what happens to those dividends. I want to think about what kinds of companies are going to be most negatively affected by this policy. So I'll give you the choices. Remember, the requirement is you pay 40% of your earnings as dividends. Large companies making huge profits, do you think they'll be affected? Can Philip Morris afford to pay 40% of its earnings as dividends? Yeah, it already pays 55% of its earnings as dividends. It's not affecting the Philip Morrises, the Coca-Colas. They already are mature companies with lots of cash flows. What about small companies losing money? Keyword is losing money, right? They have negative earnings, so they're not affected. High growth companies that are losing money, again, if you're losing money, I don't care. But what if you're high growth companies that are making money? What am I making you do? Pay out 40% of the earnings as dividends, right? But you're a high growth company. What do your free cash flows equity look like? They're negative. I'm making you pay dividends when you can least afford to. You know who likes this policy? Those large companies which are mature. Because what does it do? It handicaps your competition, right? By making high growth companies pay out dividends, you're effectively making them less competitive in the space. They'll shed crocodile tears about this mandated dividend payout, but secretly they're celebrating. This is great. No young growth company is ever going to make it through. Dividend policy. Not everybody's going to be on the same page because there'll be winners and losers when you mandate dividend policy. I think in general, mandating dividend policy is a bad idea, either in terms of setting a fixed percentage as dividends or setting a fixed percentage being reinvested. But it keeps bubbling up to the surface. Bad ideas never seem to go away. Take a third case. And this was one of those cases where I struggled with the numbers, saying I must have screwed up somewhere. The early 90s, I used to do a 2-day corporate finance class for British Petroleum. So it's the most unusual class I've ever done because there were about 20 people in the class. And they were all engineers, pulled off, the company wanted them to move up the ranks. They brought them in, say, can you teach them all the corporate finance they need to know in a couple of days? And you know what? By day one, they kind of got it. I mean, they said, this is corporate finance. This is what I was afraid of all this time. And the company I used, because I thought they would relate best to, was BP. So we went through cost of capital, betas, hurdle rates, and capital structure. And then I got to dividend policy on British Petroleum. And I computed the free cash flow equity. And the free cash flow equity I got was 571 million on average between 1983 and 92. And then I computed the free cash flow equity. It's about 1.6 billion or 1.5 billion on average over that same period. Every year, BP is returning $1 billion more in cash than it is available. So first I checked the leverage. Maybe it's under-levered. No, it was actually one of the most over-levered oil companies in the world by the time you got to the end because they were funding this extra $1 billion by going to the bank every year and borrowing an extra $1 billion. This is a dividend problem made in hell. And everybody in BP knew there was a dividend problem, including the janitor. You know why? Because he wouldn't get a new broom or a new vacuum because every dollar BP had went to paying dividends. Across the world, they constrained themselves because they're paying such a big dividend. Question you always face whenever you look at numbers like this is why didn't somebody do something? This is a 10-year period, right? It's right there. Everybody can see it's there. Why didn't they do something about it earlier? Let's play it out. It's 1987. The top management at BP are gathered together. Viscount so-and-so, Lord so-and-so, it's a British company at that time, royalty, I'm sure, was well represented. Everybody went to Oxford and Cambridge. One of them bangs the table. Oh boy, we have a dividend problem. I'm trying to act like a Oxbridge, but I don't get it right. And everybody says, aye, aye, aye. We need to do something about the dividend problem. Aye, aye, aye. We'll cut dividends. Aye, aye, aye. And then somebody asks the question, who's going to tell the shareholders? See, what's wrong with telling the shareholders? They know we have a dividend problem as well. Remember what I said about shareholders? You get the shareholders you deserve, right? You pay no dividends, who buys your shares? People who don't like dividends. You pay big dividends, who buys your shares? People who like big dividends. You pay enormous dividends, who buys your shares? Dividend addicts. They're addicted to dividends. You have a room full of dividend addicts. What are you going to tell them? I'm going to cut dividends. It's like getting a group of cocaine addicts in a room. So I'm going to cut your cocaine to 1/10 of what you usually get. You're not going to be celebrated for doing the right thing. You're not going to leave that room alive. So the I very quick says, not me, not me. I'm going to have laryngitis 3 months from now. I won't be there. And then finally, somebody in the meeting says, maybe something good will happen. Which are oil companies, what? Maybe something will happen in the Middle East. Oil prices will jump $20. There, our dividend problem will go away. They put it off till 88. Same process plays out, put it off till 89. Finally, I mean, we all agree there's a dividend problem. Finally, in 1992, BP cut dividends. You're saying somebody had the courage to do the right thing, right? You know why they had to cut dividends? Where did they get the billion every year? They went to the bank to borrow the money. And finally, in 92, they were already the most over-levered oil company. Bank said, nope, we're not lending you $1 billion. So there's the news story on the day they cut dividends. BP shares plummet after dividend is slashed. You did the right thing, right? I'll finish the story. About 6 months later, BP stock had come back to where it was. And a year later, BP was a much healthier, much better company for cutting dividends. So, but what was happening in the immediate aftermath of you cutting dividends? Those people, those dividend addicts in your room are selling their shares. There's a transition period. Cutting dividends is never going to be painless. It's going to, and that's why if you have a dividend problem, it's better to take care of the problem early rather than let it fester, because you let it fester, you got the BP problem. Because when they sold and they left the room, along the way, they actually panicked and took half the management with them. Half the management lost their jobs, and they deserved to. Because this was a problem that everybody knew was a problem. And I would argue there are lots of companies with big dividend payouts out there where you have to look and say, somebody's got to have the courage to make the change when you control the spin. Because if it's thrust upon you because you can't pay dividends, then the market reaction is going to be far worse. So if you have one of those companies and you have a big dividend difference to explain away, they're paying out more than they can afford to. First, look at the leverage. Make sure it's not under-levered. But if it's not under-levered, then the advice you should give them is, look, do something about this now when you still control how the process plays out. So if you get a chance, I would like you to do the dividend section this week. You really don't have much choice, right? You're like a week and a half. So it's not like I'll do 3 weeks from now. Do it as soon as you can. It's not as involved as the earlier sections. So if you haven't even started the process, for God's sakes, get started. But I will keep nagging you over the weekend, and I will see you next week.